Hello and welcome to the Investing Show. We're here to help you make good investment decisions. I'm Abraham Okusanya, the founder of Timeline, the company on a mission to help people retire with confidence.
In this episode of the Investing Show, we're discussing the bear market. Around the world, stock markets have fallen. In the United States, for example, the S&P 500 had its worst first half of the year since 1970. It's very important at times like these that investors stay disciplined, but it's not always easy. I've been speaking to the world-renowned behavioural scientist Meir Statman, Professor of Finance at Santa Clara University. The compulsion to act, he told me, can be very strong, and financial professionals are just as prone to it as the rest of us, if not even more so.
Professionals are really like the rest of us, like amateur investors. They're just wearing suits of the profession, of knowledge, and that is a good thing. But they're subject to the same emotions. And then, as you say, they are observed by others. That is, I don't disclose my portfolio, but they have no choice but disclose theirs. And their investors somehow, even if they are not making moves in the market, somehow they expect the professionals who manage their money to do something. Don't just stand there. I'm paying you to act. And so they act, and more often than not, they act foolishly.
You've talked before now about hope and fear being useful emotions that sometimes become exaggerated. What do you mean by that?
Hope and fear are very useful. Exaggerated ones are not. If you are fearful enough to dump all your stocks, that is bad. If you are so hopeful that you invest in something that promises 10% per week, that is bad. But generally, you have to realize that emotions are useful and exaggerated ones are going to hurt you.
So how can an investor step away when fear turns to panic? And are there, if you like, some simple rules you can recommend?
Well, I think so. I've heard from other behavioral finance and psychologists saying that those cognitive errors and emotions in us are impossible to overcome, even if you know them. Well, I think that it is really way exaggerated. Just think of the advice that you get about angry. It says, when you are angry, count till 10 before you open your mouth. And so that is a way to withstand that anger and prevent it from becoming a real danger. Now, I like to say that whenever you think about trading, about buying or selling, other than for liquidity reasons, meaning you got salary and you put it in your savings account, or you need money in retirement, you should always ask yourself, who is the idiot on the other side of my trade? Because in every trade, there is an idiot. And people people in behavioral finance will say people are overconfident. But before overconfidence comes framing errors. That is, people see trading as the equivalent of playing tennis against a training wall. That is really very, very easy. You can place yourself just right to hit the ball right. But trading is like playing tennis against Djokovic. He pretends to hit it to the left and then hits it to the right, just as you go to the wrong spot. And so every time you feel like now is the time to sell or buy more, you have to ask yourself, who is the idiot on the other side of the trade? What do you know that other people, professionals, do not know? And the true answer for most people, most of the time, is nothing. And so I am no more intelligent than other people, but I've learned that whenever I feel panicked or anxious and so on, it's not that I do not feel anxious. I do, but I just don't act on it the same way that I count till 10 when I'm angry before I open my mouth.
Do you think there's an argument for simply seeking a distraction, for switching off CNBC, for not reading the financial pages, going for a walk, or getting stuck into a good book?
Well, this might be one remedy, but there is another. The other really is to watch it or to look at the balances of your account, but really immunize yourself, vaccinate yourself against them. That is, I say, if you watch CNBC, have you noticed that there are two experts, both wearing suits, so you know that they are experts? Yet one says the market is going to go up, and the other says the market is going to go down. And so you know that neither of them knows anything, that they are just making guesses, perhaps by tossing a coin. And so if you just look at it and you just listen or rather watch CNBC with the voice off, then you will be fine.
There are many ways in which a good financial advisor can add value, but it's in volatile times such as these that they really come into their own. Part of their job, says Professor Statman, is to stop you doing something foolish.
Well, financial advisors can be really, really useful here. They are really earn their fees when they dissuade panicky investors from doing something that is really stupid. And so the first line of defense is to recognize that you don't know anything more than others. And just because you feel bad and panicky, there's no reason for you to sell. But if this is not sufficient, then financial advisors are the second line of defense, and they can reason with people and explain precisely what we are talking about and say, look, I understand what panic is, I understand what fear is, this is natural to me too. My advantage over you is that I have learned things that I am now teaching you, and therefore this is a good advice. This is a good piece of advice. Don't do anything, or wait 2 weeks to see if you can cool down and change your mind. So, some people say that advisors do nothing useful because they don't beat the market, but advisors manage investors more than they manage investments, and in that they earn their fees justifiably.
So yes, stocks and even government bonds have fallen in value this year, but that's nothing compared to the full-on crash we've seen in cryptocurrency markets. I asked Meir Statman how big a part he thinks social media has played in that.
Well, social media plays a role, but it is not really the major role. I come back to the notion of aspirations. That is, people buy cryptocurrencies or pile on a particular stock because they aspire to be rich. Or rich, I'm not talking about billionaires, I'm talking about just being able to switch from a boring job, being able to support a family, and so on. And so I really empathize with them. And so, I always go back to the kind of risks that I took. They were not really in the investment field, although I'm taking a lot of risk because most of my money is in stocks. But it was really in quitting a secure job and coming to the United States to pursue a PhD. What if I didn't finish my PhD? What if I didn't get a job afterwards? And so on. And so the question is not about whether you're going to take risk. You are. The question is what kind of risk you're going to take. And I say to the people who buy cryptocurrencies, the way to get ahead in life is not by being lucky. And cryptocurrency is a lottery ticket. It is by education and enterprise. And when you make it by education or enterprise, you will have more than money. You will also have a vocation. You'll also have something that you look forward to do in life.
Hi, Abraham.
Hi, Robin.
Now, Meir Statman makes a very important point there about financial professionals, doesn't he? We assume they're more disciplined than ordinary investors, but they're only human, and there's actually more pressure on them to act when markets fall than there is on us.
Think about it this way, Robin. Fund managers sell their services on the premise that they're able to pick the best stocks and they're able to protect your portfolio in a down market. The pressure on them to do something and not just stand there is enormous because, on top of the market risk, they have the career risk, the fact that they could lose their job, and in many cases, the future, the earnings are tied, to the portfolio they're managing. So that's why study after study shows that, you know, professional fund manager rarely offer any downside protection during market downturns.
I don't know about you, but I found Professor Statman's take on retail investors quite reassuring. Yes, it can be hard to stay disciplined, but let's not pretend it can't be done. It's essentially about financial education and some self control.
Absolutely, it's hard, but it's not impossible. And what we're finding is that investors who deliberately, abandon this notion that they can do better than the overall market, investors who go down the route of, tracking the market, using low cost, highly diversified, portfolios, they tend to fare better because their de facto approach is to not to do anything during extreme market conditions.
Now, Meir Statman calls financial advisors a second line of defense against irrational behavior. For you, Abraham, how important is that behavioral coaching role that a good advisor can play?
It's crucial. If as you know, Robin, our firm Timeline works with hundreds of financial advisor firms up and down this country, and one big passion of mine is to help make good financial advice available to more and more people. The best financial advisors stand between their clients and behavioral mistakes. Indeed, they prepare their clients for market downturns, perhaps using historical data to help them visualize how their portfolios and indeed their financial plan might fare in poor market conditions, so that when those bad market conditions do show up, the client's ready and the advisors there to provide the essential hand holding to help them get through it.
And what about crypto investors? The crash they've had to endure has been brutal. Do you think they'll learn from it, or will the lessons be quickly forgotten?
Well, the jury is out on whether you can call people speculating in crypto investors. But I do hope that this current downturn is a lesson to people that long term investing isn't about following the crowd, speculating and doing what everybody does. Long-term investing is about putting your money to great use in great companies of the world who are, creating goods and services and products that everyday people use and that make all of our lives better.
Very well put, Abraham. Thank you very much.
Thanks, Robbie. So, you've heard our opinions, but what did you make of our latest interviews? Please send us your views. From all of us here, thank you for joining us, and goodbye.